Today's Talk About It Tuesday question is, how would you creatively leverage OPM, other people's money, to get rid of high interest student loans once and for all? Thoughts on leveraging home equity or something else? Okay, so let's just talk about the concept of leverage and using other people's money as a means of leverage. So normally we use the term leverage when we're referring to an investment, right? And so to leverage means we take a little to get a lot. So for instance, if we're leveraging to get a piece of real estate, we put a down payment, but we use the bank's money to get a much larger property than we have in our savings. Or the same thing if we're starting a business or, if we're any type of investment. But the difference is when we borrow money to get something larger, the cost of borrowing is included in the payoff from the investment. So in other words, if I put a down payment, but I borrowed the rest to buy a piece of property, the rental income will cover the cost of borrowing. So that's what we're talking about when we're talking about leverage. And so when you just have a debt, and it's not something that's going to make money to pay off the cost of borrowing, it's not really leveraging. But there are techniques that we can use to pay off high interest debt. So the quickest and simplest way to get rid of high interest debt is to try to get some type of settlement, right? And so a lot of times you can renegotiate if you're willing to pay in a lump sum. And so how in the world do you get to pay in a lump sum if you don't have money? So now there are techniques and strategies to use other people's money, not necessarily other people's money, but to transfer the debt into something that's more manageable and something that's more acceptable in terms of the terms. So you can do a debt consolidation loan, right? So there are plenty of places out there that if you Google debt consolidation loans, if you qualify, you might be able to find a loan that has what we call better terms. So what would better terms be? A lower interest rate is a better term because that's going to save you money. Maybe a different duration of the length of the loan that could save you money if the interest rate was the same. So you want to get better terms. So if you do debt consolidation loan, now even if you do a debt consolidation loan, you should try to settle, because you're going to tell whoever the original loan holder is, how much would I have to pay if I pay it off in one lump sum right now? What type of deal could we make? And so whatever loan you get to replace it is not for the complete loan, but for a lesser amount. So if you can settle with the original loan holder, get a second loan at better terms, you're paying less principal and you're going to get better terms on that new principal. So what places can you do? So there's peer-to-peer lending that a lot of times we call microloans. So if you have an original loan of $50,000 or less, maybe you get the $50,000 from the peer lending at a lower interest rate than what you're paying. And again, whether you settle it or not, it's going to save you money. You can, depending on the size of the loan, some people have cash value life insurance. You can borrow from that. Some people have pension funds that they can borrow from. You can borrow from that. Some people can borrow from equity and things that they own. So if you own a piece of property, you can refinance that at, again, if the interest rate is lower, and you can stretch the payments out over a longer period of time to make it more manageable. There are home equity lines of credit if the loan, again, fits within that and the interest rate they're offering for the home equity line is less than what you're paying. So the bottom line is you save money by getting better terms or a smaller principal. So you do that by either settling for a small amount and getting a new loan at better terms to pay off that smaller amount, or again, if you can't renegotiate the size of the loan, it's just getting a better loan at a better interest rate to cover that. So it doesn't really eliminate your total debt. It alleviates the debt and makes it more manageable. So again, the concept of leverage is used when you borrow to get something greater that in itself will cover the cost of the borrowing. And that just isn't the case when you have debt that's going nowhere. So student loans, unfortunately, you've already gotten the benefit from it, and it's not going to pay for itself. And that's the same thing with some other things that you might buy. A home itself doesn't necessarily, it's not an investment. It doesn't pay for itself. So there's certain things where you make large payments, they're large purchases, and you had to borrow. And just the trick with that is to try to either cut down the duration of the loan or cut down the interest that you pay on the loan. So hopefully that's helpful. Those are strategies you can use. Not really the concept of OPM and leverage that we use for investing, but definitely, give you some type of relief. So I'd love to hear your strategies for reducing. And of course, you can always just, if you had it, pay more money on the principal, and that will shorten the duration too. But I'd love to hear some of the strategies that you guys would use and experiences that you've had with high interest debt. But please like, share, comment, subscribe, keep the questions coming, and I'll see you next Tuesday.